Welcome to students, faculty, friends, and our distinguished guests. I'm David Cronrath, and I'm the Dean of the school, and I'm here to welcome you and to tell you how fortunate we are to have a lecture series like this that's supported by the Colvin Institute. It's opportunities like this, these kind of extracurricular activities that enrich a student's experience here, and an occasion actually enriches my experience. So I want to tell you a little bit about a couple of lectures that I've attended as part of this series. So the first one I attended convinced me that I made a fundamental mistake when I bought my house here in Silver Spring. The second lecture I attended told me that I made a mistake when I made the improvements and investment to that property that I made. And today, in preparation for this lecture, I held off selling any GE stock until I hear what's said this evening.
It keeps going up.
It's going up. Okay. So, with that, I'd like to introduce someone who doesn't need any introduction, Margaret McFarland, who is the face and the voice of the real estate program.
So delighted all of you are here on such a cold night, but it's warm in here, and so welcome to our guests and our distinguished speaker, as well as our provost, Marianne Rankin, and John Colvin, who is the founder of the Institute. We're so glad you're able to be here, John. Just quickly, a couple minutes before we move to our speaker and the introduction of him, is for those of you who haven't been to a meeting or lecture recently, thought I'd just bring you up to date very quickly. We now have 250 alumni. The program is in its 8th year. We've admitted 16 different classes, and we have about 100 students, about half of whom are here this evening. And we know that they're on a path, some of them starting, some of them in the middle, some of them getting close to graduating in December. So we're delighted that they and several of our faculty members could be here as well. I just wanted to say, for those of you who haven't heard the mantra, is that the Colvin Institute is what it's dedicated to, is supporting the students and faculty in all of their enhancements for a program that emphasizes the number one thing, financial viability. And our lecture tonight really speaks to financial viability and how the financial markets work and the story of GE Capital Real Estate. But as you know, or if you don't, I'll let you know, we are only the 6th program in the country. There are now 20. But 8 years ago, we were the 6th program in the country to address real estate outside of a business school context and still address the finance and still then address the what's socially responsible, that what is environmentally respectful, what's often called the triple bottom line, and we joyfully embrace the 4th bottom line, which is to say what is beautiful and sustainable design. And so all of the students who are here know they chose this program because we have the breadth, but we never can forget that none of that happens without the kind of financing that GE Capital Real Estate provides for doing really terrific real estate that where we live, work, and play. I do want to say briefly, and you can read in your program as well, we much appreciate John's founding gift that makes the Colvin Institute and all of its activities possible. And he is an alum of the university, as well as Coco, as well as Tom Burton, who is going to introduce our speaker. Tom Burton is the Chief Investment Officer and Chief Operating Officer of Alex Brown Realty. And those of you who have not been in Maryland very long or haven't done your homework know Alex Brown is the quintessential leading real estate firm in the state of Maryland. So we're very proud to have Tom here as a Maryland grad as well to introduce Ed Coco.
Of course, my day job, I work for Margaret. I teach a class here. I do the other on the weekends. But so good evening. Glad to see you all here, and it's my great pleasure to introduce my friend Ed Coco tonight, who's going to give the Colvin Institute Fall Lecture on real estate. So Ed is a senior managing director at GE Capital, and he's responsible for national sales in the United States for GE lending. So Ed's going to share with you his experiences at GE, but I can tell you, just to sort of put it in perspective, Ed's responsible for overseeing a team of loan officers that originate $5 billion in real estate loans every year. So to put that in perspective, that's probably $5 billion would probably be larger than the top, say, 5 or 6 U.S. banks in the country in terms of loan production. So it's an enormous responsibility, and Ed has been enormously successful in that role. This is a bit of a homecoming for Ed, as Margaret noted. He's a University of Maryland graduate in 1987, and he got a Bachelor of Science here at the University of Maryland. And then from there went on to work for Trammell Crow, which I find interesting because when I was in grad school, I heard that you had to have a Harvard MBA to work at Trammell Crow, but Ed ended up there. It's a great first career job. This was sort of late 80s. Great first career job. And because Mr. Colvin had not yet endowed real estate as a degree here, Ed went to NYU to get his master's in real estate and finance. From there he went to Equitable Real Estate, which for those of you who don't know, was a large insurance company based in Atlanta, had an enormous real estate portfolio. And so this is what, 1992, and I'm guessing that Ed cut his teeth, as many of us did in the early 90s, doing real estate workouts. So great. It's like you would never script it, but if you have to do it, it's actually a very good training ground. In '96, Ed was asked to join GE Real Estate, where he started as a loan officer, and 10 years later became responsible for overseeing all of the loan officers in the United States. So that's 2006, just in time for the next big real estate recession, and he's going to tell you all about that. But I'm going to tell you actually two things about Ed that he's probably not going to share with you, or probably didn't plan on sharing with you. One is we are fraternity brothers. So Ed and I both lived for a time at the Sigma Chi House at 4600 Norwich Road, which is behind Leonardtown, and is now a boarded up building, and would be a great project for anybody looking for a capstone project. It'll involve all kinds of things. You'll learn about, maybe we could talk about takings action and so forth, but that'll be topic for another day. But please see Ed and I if you have any interest in that. You must be very ambitious if you do. But so I'm a couple years older than Ed, so I really don't have any stories about to share with you about any research you may have done at Bentley's or the Vue or any other properties on Route 1. But I can tell you that he is famously remembered for every night getting up from the dining room table. We would eat dinner at a big dining room table. All of us would eat together. He would get up from the table and he would walk up to the library with an enormous pile of books. And in fact, he and his roommate would walk each every night with this enormously large pile of books. And so if any of you who have children or can imagine a freshman in high school, how they walk around with all their books because they haven't figured out exactly how. So that was Ed and his roommate, and no one really knows why they did that. He's very competitive, I do know that. Maybe there was a competition between him and Greg. Was your roommate?
GPA was higher.
His GPA was higher. Anyway, but for whatever reason, that's what he did, and it worked. We shouldn't challenge him on it. The second thing I'm going to tell you about Ed is that he's actually the first student from the University of Maryland who graduated with a major in real estate. This is 1987. The Colvin Institute has not been founded. A real estate major doesn't exist, graduate or otherwise. But Ed knew that he wanted to work in real estate, and so he sat down with his academic advisor, and they actually put together a curriculum of classes that included multiple disciplines and would look like a good real estate major. So he took classes in engineering and in business and finance, in architecture and in social science, and together cobbled together what I think is actually very clever, very smart. So we have tonight the first real estate. We should put a picture of you somewhere, maybe after tonight a statue. But it'll be our first real estate. We have a statue of the first president. Why not the first real estate major from the University of Maryland?
All right, this is getting deep.
I know it is. I got so enthusiastic about you speaking tonight. But in any event, Ed, thank you very much for being here tonight, and the podium is yours.
All right, first of all, do I need a microphone? No. Can you guys hear me all right? All right, first of all, thank you very much for having me. I'm very excited to be here. Tom asked me to do this in September, and I was looking very forward to actually coming to the university. Very fond memories. Tom kind of went through my background. I was here for 2.5 years. I basically transferred in the spring semester of 85, I guess the beginning of 85. And had a great experience, fraternity brothers at Sigma Chi. It was just a very fun experience. I met my wife here, she was an Alpha Phi, and we got married in 1992. So, getting started, if you look at my background, Tom kind of talked about the highlights, so I'm not going to talk about the early part of my experience at Trammell Crow. But when I started at GE in 1996, when I got there, I came from Equitable. Equitable is a more, friendlier type of environment, much more, you work together, you partner together, you kind of partner on deals. And obviously there's a lot of RTC workouts that we were doing, so we were going through that. When I got to GE, it was like swimming with sharks. The environment was very combative, very competitive, and it was either as a shark, you have to keep swimming or you're basically going to get eaten. So my experience at GE taught me, within the first year, I realized I knew what I had to do in order to get ahead. And it was basically focus, work very hard, and start really kind of figuring out what I was going to do, which is the origination side of the business. I started out in Atlanta as an originator. One thing led to another. In 1998, so the first year, 96, I didn't close any deals. In 1998, my team, actually it was myself and another woman, we closed $1 billion. And that kind of led to the start of my career at GE as kind of one of the larger originators in the business. The rest of the bio here kind of goes through it, so I'm not going to kind of go through everything. One neat experience I'll tell you about, I have, when I took over the East Coast, Dan Martin, who's sitting in the audience, and this will kind of give you an idea how I kind of operated within GE. Big company, tough to get things done. Dan calls me up on a Friday, and he wants to resign from the company. And Dan is my best sales guy in my DC office, also I thought a friend, and he wants to leave. He wants to leave me high and dry with another gentleman that's probably close to retirement, not very good at originating, not very good at structured finance type deals. So I basically I hung up the phone with Dan, called the HR department, said we're going to promote Dan, we're going to demote the other gentleman, and stop, you can't do that. So Monday morning I flew up to DC, literally promoted Dan, demoted the other gentleman. He left 2 months later, and Dan's been running our DC office since 2002, 2004. And so that will give you kind of the idea, kind of how I work in the environment. GE is a big corporation, very tough to get things done, but you basically have to operate in an environment where you just don't take no for an answer. You just figure out a way to get it done. And as I go through my presentation, you'll see how I kind of partner with all the businesses, from the risk side, the closing side, the underwriting side, obviously the new business side, and the pricing side to figure out how to get deals done. Because internally, you have to work with everyone internally as well as your customer externally. So you'll see that throughout the pitch. Getting into it. So what is GE Real Estate? What do we do? We are a structured finance lender. And if you want to know what our strike zone is, our strike zone is, we're a value add player. Our strike zone is basically financing deals between a 7% and an 8% debt yield. So all these properties typically have some kind of leasing risk or some event risk that is going on in the property. Either it's multifamily, office, industrial. And the borrower is trying to execute a business plan that obviously increase the value and sell it at some point in time. Our typical loan is 1 to 5 years. Some assets will be below a 7 debt yield, and if you understand what debt yield is, it's NOI divided by the debt. And so some deals will be below a 7 debt yield, some deals will be higher. Most of the banks, Wells Fargo, JP Morgan, do deals at 8 and above. So they're very competitive. The pricing's more competitive. Our pricing is usually about 100 basis points wider than a lot of the larger banks because we're a finance company. So we operate in that finance company space, and our leverage is between 65 and 75% leverage. In 05, 6, and 7, and I'll get into it for later on, our leverage is going up to 85, 90% in order to compete in the market. That was a very bad idea, and I'll show you why later. And so our model today is maximum leverage is 75%. Our niche is very competitive because the banks typically stop at 65, so we go from 65 to 75, which is a competitive niche in the market for us. We find it actually a competitive spot because there's fewer players that can play in our space, and we can take down very large transactions, which I'll go through in the next few minutes. If you look at our business model today, you know, if you look at an office deal that we've done for $52 million in it's actually in Charlotte, North Carolina, called the West Trade Building. It was an acquisition, you know, a $52 million loan, 75% occupancy. The borrower wanted to lease it up. Actually going in cash was like 7%. And the borrower, we just actually closed this loan about 6 months ago. The borrower's already executed on his business plan to lease it up. This is a Class A asset in downtown Charlotte, you know, well located, and these are the kind of assets that we want to finance. The one on the right is a big multifamily deal that we just closed in Chicago, K2, Class A multifamily deal. If you looked, compared it to the assets that we were financing in 05 and 6, you really scratch your head, because a lot of the multifamily deals we did in 05 and 6 to be competitive were the older 25-year-old multifamily properties that needed a lot of CapEx and at a much higher leverage point. The retail deal below, it's actually mixed use, $141 million, high quality asset. This one I think happens to be in Naples, Florida. A very well located property, has retail, office, and a condo component. We only finance the retail and the office component. And again, very high quality, again, taking out a construction lender, borrower wants time to stabilize the asset and then actually either sell it or put permanent debt in place. On the right side, if you look at the kind of the equity portfolio, we're in the process right now of selling all our equity in our real estate portfolio. Our equity book at the top of the market reached about $45 billion of equity across the globe. And we've been in the process of running that down in a major way the past 3 years. We actually waited for the markets to come back. These are a couple examples of kind of assets that we've been selling off between office, some of the multifamily assets. We actually just are in the process of executing a very large deal with Blackstone, selling about $4 billion of multifamily to them. And actually we just signed another term sheet to sell Blackstone at about $2 billion of industrial assets as well. If you look at kind of the market from 2008, and these are some of our comeback deals that we did in the marketplace. I structured a deal in 2008. It was a $940 million loan right before the markets really crashed. This was one of the best loans we actually made in the portfolio. The first half of 08 was probably the best market that I saw for GE real estate in the lending space. Everyone else left. Okay, so we really had, it's like shooting fish in a barrel. We did $4 billion in 6 months, and then at the end of June we shut the business down because capital markets were really starting to blow out. It didn't impact us because we were a balance sheet player. We had plenty of capital to actually lend in that market. But then as soon as the capital markets started really to freeze up, our liquidity started to dry up. This is a particular loan that I'm very fond of because Jay Sugarman's a personal friend of mine. He runs iStar. This actually helped him stay alive through the down cycle because if he didn't get this loan done, iStar probably wouldn't be in business today. He was banked between a friend of mine at JP Morgan, who was an investment banker, and myself at GE. And he has, had a great franchise, but again, got caught on some of the condos in the residential side of the market back in 06 and 07. In 2011, we structured a large deal with Blackstone. It's called the Duke portfolio. They bought the Duke portfolio, big suburban office portfolio. Everyone thought John Gray was crazy financing, suburban office in 2011. No one really wanted it. John Gray stepped up and bought it. Why did he step up and buy it? He bought it at a 9.2 cap rate. All right, so his leverage return on that deal is about a 15% leverage return if he doesn't sell it for the assets for a gain. Our debt yield in that portfolio is about 11.2%. We felt like we were lending, it was great money for us, it was a great loan for us. We took down the entire loan for him. We syndicated some pieces out post-closing, but it was one of our first big loans in 2011 as we got back into the market. We got back in late in 2010. In 2012, not to belabor the point, we did a large industrial deal for him as well, $575 million. Again, similar situation. He was buying it for a little tighter cap rate, probably 8, and our debt yield was closer to 10. Again, another great buy for Blackstone, very smart buyer. Obviously, if you read the Wall Street Journal, they're all over the market taking a lot of they just took Brixmor public as a public company. That's their retail business. This year we did Maristar, big hotel portfolio for them. This is a portfolio they bought and the markets were distressed. Again, their timing was very good. We just actually refinanced it. They had a CMBS loan and we took it out. So these are the loans that we kind of use to come back into the market, in addition to a lot of the loans I just showed you earlier. But it's kind of more, the nice thing at GE is we can do larger loans. The one thing the market can't do as well as we can take these big $500 to $1 billion loans down and really provide liquidity to some of the private equity firms that really need to close very fast. Because a lot of times if they go with the bank syndicate, the banks have to syndicate it with 5 other partners. It's much more complicated. And and Blackstone worked that well because they really wanted floating rate debt. They don't hedge. They bet, interest rates, LIBOR was going to stay relatively low, and did a very good job. And all the deals are doing extremely well for them. Some deal examples, some other deals that we've done in the marketplace. West 7th was a nice mixed-use deal in Fort Worth, Texas. A $98 million loan. This deal was done in 2000, right when we were getting back into the market in 2011. Again, this is the type of deal back in 04-05 we wouldn't have competed on. We would never have competed for this type of asset. That's why I'm showing it to you. And in fact, the guy that ran my Dallas office didn't think we were going to do it either, because we historically haven't done these types of properties. We actually closed this deal, signed it up and closed it within 30 days. It was really one of the great deals that could get back into the market. The Alta Domain deal was done with Wood Partners. It was done in San Diego. This was a deal that the developer finished construction, wanted to pay off the construction loan because he wanted to start 2 more projects with the same lender. They needed to clear their line. We took it with 20% occupancy. We closed it, paid off the bank syndicate and their main lender, and they leased it up 18 months later, and they'd actually just executed on the sale of the property. They're the same borrower that we did a K2 transaction with in Chicago. Mercado's a deal that we're closing tomorrow, right, Andy? That's a beautiful mixed-use deal in Naples, Florida. And Legacy is a firm out in the West Coast in San Francisco, another borrower that has 7 or 8 million square feet out in the West Coast that they're a big customer of ours. All right, so where's GE Real Estate? GE Real Estate's a global real estate business. The peak assets was $93 billion, and it was probably 50-50 between debt. Now it's probably 60-40, 60% equity, 40% debt. The equity got a little bit out of control back in 04, 05, and 06 because, like anything, everyone got carried away because everyone knows it was cap rate compression driving the markets. It wasn't as much about the rents going up. It was really cap rates were declining, and so values were going up. And we sold many assets and harvested a lot of gains, but the company couldn't let go in 06 and 07. They wanted to try to continue this model, try to build it through the cycle. There was talk that the recession was only going to last about a year and a half or so. Real estate wasn't going to be as impacted. GE was already selling down its consumer debt business, didn't want to reduce real estate that much. So what do? They double down. They actually start doing more lending, some more equity. So we kind of got caught in 07 with a large portfolio. When the markets kind of froze after Lehman, that's when we started to look at the portfolio, trying to figure out what's the best way we were going to play through in this market. No one panicked. The senior leadership team, all the way up to the board, didn't panic. We kind of worked to play through. If you imagine, I'm in North America. I'm located in Atlanta. Headquarters is in Norwalk. You got offices in the UK, all over Europe, Germany, Paris, Poland, Sweden. You got offices in Japan, Korea, Australia, and obviously Canada and Mexico. We had a large business. And in fact, in this recession, it wasn't like, we always thought like one market or 2 markets would go in recession, not the whole entire globe. So we had a big problem on our hands, and we actually spent a lot of time working through the portfolio. The one point here that I want to really kind of drive home to you guys, I have 18 years at GE. Dan and Andy probably has 16 to 17 years themselves. We have asset managers that have 25, 30 years of experience. Our CEO has been at GE since he was 22 years old. He's 55. So a lot of us have a lot of GE history. We've been there a long time. We've seen a lot. If you go to my peers at the banks, they change jobs every other year. They're always looking for the next best deal. And in our situation, a lot of us at GE, and it's not just the people in the U.S. I travel and I see people around the world. We're all friends. We're all partners together. We built this big business up, and we wanted to really figure out how the best way to take it back and actually regrow the business, which took some time. So if you look at our track record, when I got to GE in 1996, the net income was, I think, about $100 million. And then all of a sudden, the income started to really accelerate in 2000 and all the way up to 2007. We bought the security capital portfolio. Actually, my boss negotiated that deal. We bought the security capital portfolio, I think it was in 2001. It had self-storage, it had industrial, it had, I think, multifamily. It was a huge portfolio that we bought. That was one of our first big equity transactions. We basically took a public company, broke it up, and started selling off the pieces. The company actually liked that idea, so we actually modeled that same idea in Europe and in Asia. We did the same thing in those markets as well. It worked out to, it started out to be a huge home run. If you look at the income, 04, 05, 06, and in 07, we peaked out at $2.3 billion. And at that point in time, a lot of us knew the income was only going one way, and it was going down because the capital markets were freezing. So everyone started to get real nervous. In 05 and 06, we had conversations, do we reduce the book? We didn't follow through on it, so we knew what we were in for, so we just decided to basically focus and try to work through the portfolio. 08 was very tough. I remember in September of 08, you guys read all the headlines. I got a phone call that we didn't know if we could turn GE commercial paper. The markets were freezing. You know, I kind of always knew Lehman was at risk because we dealt with Lehman. When we would do a first mortgage, Lehman would do the mezz on almost every transaction we were doing, and Lehman was doing 100% of the mezz. So a lot of the borrowers had no equity in their deals. So we would do a 75, 80% loan. Lehman would take it up to 100%, and a lot of those deals were starting to break. And Lehman was had to be 75% of the transaction. It was actually an amazing situation. And so I kind of felt like Lehman was going to have a problem. I didn't realize what it was going to do to the capital markets if they went down. And so that really was very problematic. So basically in 2008, we started hunkering down. I'll give you a funny story. In 2009, our business meeting was in Tarrytown, New York, at a Marriott. And the year before, we were in Rome, at a beautiful hotel, and we were all celebrating the $2.3 billion of net income. And then so we go to Tarrytown in 2009. You know, Emil's coming in, you know, Mike Neal's coming in, who runs capital, and they're basically telling us to keep our chin up. I'm used to staying like in the suite because I run sales. I'm like, you know, usually taken care of. I'm in the back of the hotel on the ground floor facing the parking lot, and I think I'm getting fired like the next day. I mean, it was pretty scary, and the conversations were pretty blunt. Jeff Immelt and Mike Neal came into us, and they said, guys, this sucks. We understand the situation. We know we're part of the reason why you're in this situation. You're our team. Now just go basically sit down, figure out how you're going to work through it, how you're going to maximize value. We have plenty of capital to throw at it if we need to, and let's work through the portfolio smartly and kind of grow through it. And you know, Mike Neal, the guy who ran GE Capital, is a friend of mine. Jeff Bornstein now is the CFO at GE. I had lunch with them like 2 weeks later up in Norwalk, and they said, Ed, you're not going to do a deal for the next 2.5 years, but you're not leaving the company. You're just not going to leave the company. We want you to basically take your team from 160. They didn't tell me how small my business was going to get. So I went from 160 to 30. So my job was to basically shrink the team and basically move people into asset management if I can save some jobs, some of my best talent, which is what we did. Some people we laid off. Some people we moved to other GE businesses. So we tried to figure out what was the best way to kind of shrink the team as diplomatically as possible. I know a lot of people in the business. I was able to find, if I couldn't put them in a workout job, many people in a workout job, I was able to move them to other companies like Trimont in Atlanta doing workouts. So it worked out really well. It's nice to be connected in the business and have a lot of friends because obviously the workout groups were hiring, so a lot of my people had a lot of experience, so they were obviously picked up very quickly. If you see the earnings, 08 wasn't a bad year. We made $1.1 billion. It acted like we lost $1.1 billion, but then when you drop from 2.3 to $1.1 billion, that's a problem. 09 was terrible. 10 was horrendous, and 11 you couldn't see the light at the end of the tunnel. So what do? I mean, we grew too fast at the peak. Clearly, let me kind of go through it with you. The equity business really got out of control. Everyone was focused on harvesting gains. And obviously the debt business actually took a back seat. My business was taking a back seat in 05 and 06. If you remember that time cycle, many of you might be too young, but the CDOs, SIVs, structured investment vehicles, CLOs were very active. That impacted my business because a lot of borrowers can go to a bank, get a bank loan for 50, 60% leverage and get a mezz loan up to 90%. And the blended rate was 300 over, 250 to 300 over. My rate was 350 to 400 over. So we weren't as competitive. So what we did, we went up the leverage curve as well. So we started doing some 90-95% loans to stay in the market. We did it more on multifamily than we did in any other asset class, and we thought multifamily would be probably the best place for us to play. The problem was, 25-year-old multifamily, southeast, southwest, Arizona, lots of CapEx. And once borrowers have too much leverage and have mezz debt behind them, and they only have 3 or 4% of their own equity in the game, they walk fast. So you basically get stuck with these assets. The mezz guy disappears because they don't have an asset management team, so we have to step in. A lot of work had to go in to kind of fix these assets and repair them. Some we fixed, some we sold, but we cleaned up the debt portfolio. On the equity side, we just basically figured out the equity portfolio. We figured out what assets we wanted to keep, what assets we wanted to sell. A lot of them were actually very good quality, so we kind of put more CapEx. We were prepared to put TIs and leasing commissions into a lot of on the equity assets. I talked to JLL, CBRE, a lot of them on the leasing side, and they said the nice thing about GE in the down cycle is you guys had plenty of capital to put at the assets. So if we had a tenant that wanted to go in, you guys can write a check for TIs and leasing commissions. You could do CapEx to a building. 2/3 of their other borrowers were all upside down in their assets, didn't want to write any more checks. They couldn't get the money from the banks. So we actually had an advantage in that marketplace to keep our assets relatively leased in a very bad market. So that play worked out very well for us. The equity side of our business, we were fine in our leveraged equity model where we would do like a 90-10 deal with an operator. We would fund 90% of the equity, but all that equity was leveraged by a bank loan at 70% leverage. The bad idea that we had was when we were trying to grow more in the cycle, we did 100% equity. The problem with doing 100% equity on GE's balance sheet is you can only negotiate with your GE treasury if you wanted to pay the loan off at a discount, which doesn't really go over well. And what we found out, our leveraged equity model, a lot of lenders at that point in time wanted to get out of a lot of their loans because they were trying to downsize their book. So we were actually able to negotiate favorable terms with many lenders to actually pay them off at a slight discount, and we were able to put more capital with our operators, which turned out to be our biggest gains ever. Because we doubled down on our own equity portfolio. We couldn't go outside and do it on other assets. We were able to negotiate deals with lenders, double down on our assets, and the assets actually turned out to be very, very successful. In fact, we would basically take it down to, if this was 2010 and 11, we'd basically mark the asset down to market. And then, as everyone knows, a lot of multifamily properties in 11, 12, and 13 went up 40, 60%. So we harvested all those gains in the past 12 to 24 months. It really worked out very well. But 100% equity on GE's balance sheet was not a great idea, but it was at a time that we were just trying to put out so much money to keep generating cash flow. On the lending side, 75% lending on our side today is perfect. We can maybe do 80%, but really 75% lending is really a good strike zone for us. Tom kind of mentioned it, we're going to do about $5 billion of lending this year. That's a good number for our space. We still have several competitors, and the nice thing is we can take down large deals and some small deals as well. But that leverage level works out well. If you go much over 80 to 85%, you basically have a negative debt service coverage. And in a market where you have a relatively slow growth economy, that may not be a great idea. At least the deals that we're doing today all have a 1.3, 1.4 debt service coverage because interest rates are so low. If interest rates go up, we still have more room to kind of manage the portfolio because the debt service coverage will get tightened a little bit. But you assume if interest rates go up, the economy's improving, cash flow should go up, you should be fine. Obviously the highlight, portfolio too big with too much equity. And it was 60% equity, it was way too much. And that's not just the US, it's definitely global. A couple of things, the reason why I probably still have my job. Back in 2006, when the CMBS market started to freeze, my credit guy and I in Dallas, David Martindale, who basically was my credit guy today, I started at GE, we were talking and we basically decided to shut down our CMBS business. That's just the commercial mortgage-backed securities. One, the banks are very competitive. The margins were very tight. We really couldn't make any arbitrage on the loans that we were originating. The leverage was going to 85, 90%. And the model, frankly, was just flat out broken. And this was in 06. We did some deals from our core customers that we didn't have to compete on, that were commodity-type loans. They worked out fine. Everything was properly hedged. But we pretty much shut down the business. So that was a huge savings, because there was news, and there was all of the news that GE's sitting on $30 billion of CMBS. Untrue. Because my group was in the middle of it. We basically had nothing when the markets crashed. The other thing is, we were a big condo conversion player. One of our big customers, Sunny Con out of Miami, big condo conversion player. We banked them all the way through, from the mid-'90s all the way up to 2005, basically 2006. He came to us and said, get out of the condo conversion space. Just start liquidating. Let's liquidate our stuff. Liquidate your deals you have with other customers. He said the markets are going to correct. He went all cash. We liquidated our portfolio. I think we got caught with one asset. And the timing was absolutely perfect, because the markets absolutely imploded on the condo side. We were out of all our condo conversion assets. And that turned out to be a huge win for us, because all that exposure was taken care of. So the only challenge that we had was some office deals that were a little bit over leveraged. Markets were a little bit soft. There were B quality office buildings. And as everyone knows, when the market cycles down, B office buildings get killed, A buildings get leased at a lower rent. So all the tenants went from the B buildings to the A buildings. So our B buildings got crushed. So today we're trying to finance A buildings. It's a much better model, much more sustainable. And so far it's actually working. The turnaround. We basically, we did a great job shrinking the book. We did it the smart way. The whole business was very patient. This wasn't just the U.S., it was definitely very global. Everyone was involved. We have a lot of experienced asset managers. I started in asset management in the down cycle in '92, and we did a very good job. I mean, small and medium-sized companies can't throw capital at it like we can when the markets cycle. We knew we could put capital at it. We just didn't realize how bad the markets were going to get. But being patient, working the assets, really helped us kind of get through the cycle. If you look at GE's going to announce, we announced earnings last, at the end of October. Real estate's having a phenomenal year, huge recovery year. And the team is just really excited about the recovery of the business. I think we're going to generate about $1.6 billion of net income. A couple of that is like some one-time gains. But from losing $1.7 billion to generating $1.6 billion of net income is a huge turnaround for the business. The current CEO that we have running the business came in 2011 and has done a fabulous job kind of right-sizing the business, making sure everyone's focused on the right thing. The previous CEO did a great job up until that point, but this is kind of a lesson learned. He was probably too close to too many people, didn't want to let senior people go, and so Immelt let him go politely. And he was a very senior guy at the company. Mark Begor comes in, my new CEO, and I'll give you a little story about him. He comes in, he's the Iceman. And he basically shrunk the entire business over the next 2 years. Very tough guy, very energized. I mean, so I'll give you kind of I ran the New York Marathon a week ago. I did the Boston Marathon with him, and I ran the Miami Marathon in January. And I have never run a marathon before in my life. He coaxes me into running the marathon with him at the Olympics last summer in London. He's beating on me. Come on, Ed, run. He wants somebody to run with, thinking he's just going to run away from me anyway, so it doesn't really matter. So he's very persuasive. I thought a great idea. I'm going to go run with the boss, right? This is great. New York gets canceled last year, so we don't run New York. I run Miami as a warm-up. I almost died because I get dehydrated. I did finish. So I go run the Boston Marathon with him because he convinces me to run that. And he cramps up at mile 10, and I finish like 22 minutes ahead of him. Not a good idea to beat the boss, especially when all the people in the office are actually watching online. But he's a very energetic type of man. He's done a great job rebuilding the business. Very senior guy at GE, and Mark Buer gets a lot of credit for basically putting real estate in the position it is today and generating the gains that it's generated. And if you look at the bottom right-hand corner. The volume is 4.6 billion in 12. That's globally, and then estimated volume this year is about $10 billion. In the UK, we're buying actually a debt portfolio from Deutsche Bank that we're trying to close on very soon. That's like 2.4 billion. So over in the UK, there's still a lot of opportunistic deals that we think we can buy and actually make money on. So we're actually pursuing that quite a bit in the UK. We're not doing much in Paris or Germany. Markets are too competitive. And then we're obviously doing a lot of stuff in Australia, believe it or not. We're doing probably about $1 billion of originations in Australia. Japan, the banks are too competitive. Real estate turnaround, some of the kind of things that we did, face reality fast, total focus on the problem. You really can't hide. The cycle hit us so hard, you basically have to kind of face it head on. The business did a great job, as I talked about. They really kind of, went at the problem, realized they knew what they had, they worked through it, they got a lot of support from the board, which is what it takes in a big company, but they knew exactly what they had to do. Shrinking's hard. The layoffs are really tough. We tried to keep the best talent. We moved the best talent to some of the asset management workout spots. And on my team, there was a lot of younger talent. So we moved a lot of the younger talent to that side because we have a lot of experienced asset managers. So the asset managers needed a lot of junior people to kind of run the numbers. So it really worked out perfect. And these guys got great experience like I did in the early 90s doing workouts. Workouts are probably the best place. If you're going to be in a lending space, workouts are the best place to learn the business. And if you're a developer, you have to learn the cycle. So when cap rates start, going to unrealistic levels like 4%, 3%, it's time to sell everything, get out, go on vacation, go to the beach, and then wait for the next cycle. The one thing I will tell you is when we were shrinking the business, many people in a big corporation, many people sometimes start to think that they're better than the company, that they're more important than the company, it's all about them. When a down cycle hits, nothing matters. So as you're growing through a company, never think you're better than the company because the company will always go on without you. Even though I run sales, I can leave tomorrow and the company's going to move on. Mark Begor can leave GE and the company's going to go on. We had 2 other CEOs that thought they were invincible, the company went on. But so the lesson learned there is when you work for a big corporation, never think you're bigger than the company. If you run your own platform, you can do what you want. Again, you got to treat people with respect if they're going to work for you. But in a large corporation, always work as a team player and always be partners with everyone on the team because it's really critical if you're going to actually grow in your organization. Because sometimes as people are up for promotions, how does that person partner with other people within the business? And it's not just the people on the origination side. How do you treat your underwriters? How do you treat your closers? How do you treat the asset managers? It's very critical. How do you treat your finance team? Very, very important. Operational focus, just stay focused. Leave no stone unturned on anything you do on any of the assets that you work on, especially in the asset management side. Even on the origination side, we underwrite everything. I tell borrowers up front when we're looking at a new deal, tell us everything because if you don't, we are going to find it. Give you an example. We're working on a $160 million deal in Texas. The deal's up for credit. My senior credit person reads the credit request, sniffs out that there's some kind of engineering report for the elevators. Somehow she figured out there's some report that we don't have. She was right. There was an elevator report. There needs to be $4 or $5 million of CapEx. The guy that works for her kind of has a black eye because he didn't spot it. She figured it out. Sure enough, I got a report 2 days later on my desk. And the borrower had to post a guarantee for the cost of the elevators. We don't really know what it's going to cost, but he had to post a guarantee in order for it as an acquisition for us to close the loan on a timely basis. But we find everything out in due diligence. It's when you have so much information on a deal and you have so many eyeballs looking at a transaction, the information comes out, especially at GE. We're very thorough. I think the point about balanced growth with exits hard. I mean, when you're shrinking a business, right now we're making money, but we're still shrinking. The company, GE, managed that side of the business very well because we had a lot of people that have plenty of lead time to actually start looking for opportunities. The business knew that the equity business was going away, gave them a lot of time, let them work through the assets. A couple of asset managers are probably only working on 2 or 3 deals, but they have to the end of the year to finish it up. And they have plenty of time to look for some new opportunities, either internally in the company or outside the company. And ironically, many of the people that left my team were able to find jobs very, very easily with kind of the background they had internally at GE. What I learned along the way, communication, open, clear, honest, and obviously as much as possible. We conference calls all the time, talking about what we're doing on a daily basis. Seek out feedback every day. Always kind of ask yourself, what can I do better? When you're downsizing a business, you're not going to do everything perfectly. Make sure you get input. As I travel the country and I meet with my regional managers, I meet with the analysts, that we have in the offices, and I meet with the asset managers, I always talk to them and say, what can I do better from the growth side? How can I communicate better? What do we need to do to just become more efficient, to try to save some time in the process? Very, very important. Learn about competitors, industry. Half of what I do is communicate to the outside market. And a lot of my competitors, I've known a lot of these guys for years, so we know our space very well. We know where we compete. We're in that space of 65 to 75% leverage. I know who's trying to compete with us. I know where my friends at JP Morgan play. I know where my friends at Wells Fargo play. I know where the life companies go. Then I know where Mesa West or NXT Capital, some of the debt funds that have raised capital out there, they're trying to compete with our space. They just can't do it as efficiently because they don't have the number of underwriters or closing people that can throw out a transaction, and they don't have the capital. We can do large transactions, which makes us more efficient. When you can do large deals, a lot of people want to work with you and use that to sell around some of your competitors in the marketplace. But you want to know what your competitors are doing on a daily basis. Be the best at everything you do, but be humble. I mean, the one thing I learned at GE, I rised from a relationship manager in Atlanta. I grew in the company. I never had a move. I'm kind of an anomaly at GE, but I did it my way, the non-corporate way at GE. I never, even though I was very close with the guys that ran GE Capital, I had a very good network within the company. For whatever reason, as I was doing $1 billion of transactions in 1998, people took notice. So I was very fortunate to get a lot of accolades, a lot of support. I could pick up a phone if I had challenges, but I was always very humble because it was always about the team. It was never about me. The one thing, we at GE has a lot of these award programs, these pinnacle trips to go overseas, these summer trips. I always passed them on to my people that actually did a lot of the work. I mean, I was in the front end trying to hook a deal, but I had a lot of people helping me get these transactions done as I came up in the company and as my pyramid got bigger. I mean, in 98 it was me and one other person. By 2004 I had 30, 40, 50 people. And then in 06 it was as much as 100 because they consolidated people into me. But if you look at it, you got to be humble, you got to treat people with respect. One of the biggest things that I learned in the company is in GE, credit's very important. I can't do anything without my credit person. So if I try to go around her, go over her head, or try to do something that's not smart, I'm just going to lose. I mean, I cannot go around senior credit. If she doesn't want to do a transaction, she's not going to do it. Even the CEO of our business can't really approve a deal unless the credit person wants to. And that's the way the company's shaped up. In 05 and 06, it might have been a little bit different. They would have got their arm bent a little bit. Today, they dictate if we're going to do a deal or not. So my job is to sell as much to her as I do externally. And I have to work very carefully. I mean, these guys know how hard I work and how much I spend internally trying to make sure these guys are getting their deals done. Because at the end of the day, I'm responsible for them, and I take responsibility for them. I tell them to push as hard as they can, and my job is to get it across the goal line. At the end of the day, it's my job to finish the deal and get it transacted for them, and they do a lot of work. So they want to make sure that you have their back. And when you have people from all the different offices around the country, you have to work very hard in a large corporation to make sure that process works. And if I lose credibility with credit, I need to change jobs, the bottom line. You're just out. And that relationship to me is very, very critical. It's as important as the Blackstone relationship on the new business side. Push your boundaries, take on stretch roles. You know, when I was in 98, 99, I hated speaking in front of people. I liked small audiences. I was great with 5, 6, 7 people. You know, as I grew in the company, I enjoy it. Because now the thing is, I have so many stories to kind of share with people, and I've learned so much about how people work and in their demeanor that I love to learn from everyone. So as I go around and I travel and I speak to people, I always get good input about what people like to hear, what people want to do. You know, the one thing from my perspective, when you grow up in an organization from the very bottom, basically as a relationship manager, you're climbing the ranks of GE and you're all on the front end, you have to learn how to survive. And when you do that, you actually try to give people the real story about what it takes to succeed in a big company. And like many people here, when I graduated from NYU, I always knew I wanted to be in the real estate business. The question was it going to be on the equity side or was it going to be on the debt side? Once I did workouts, I ended up staying on the debt side and never really looked back and just kind of worked the system. And it's very, very important to try to stretch, though. And the reason why I stretch is when I took over the East Coast, the next step was taking me over the country. And you know, originally when you start in a big company and you're known as a salesperson, people don't think you can manage very well because you're a salesperson. I had to prove to people that I can actually manage people, and that's one of the things I actually enjoy the most. Build a team, surround yourself with the best. We have, obviously everyone knows at GE, you cut the bottom 10%, in my case, bottom 25%. I'm very focused at shaping my team, shaping my business. I'm very close to people, but if they're not doing a great job or getting, need a change, I tell them. If someone's not doing it, I'll personally tell them, you need to start looking for another job. I won't send them, I won't write reports that, actually someone else will do that. I won't write reports that actually tell them they're not doing a great job. I kind of politely tell them to look for another job. And frankly, it's the best way to tell people that actually people end up getting new jobs. It's very efficient. It's much quicker. It just saves a lot of time. Saves HR headaches with what they have to do. But you just try to communicate openly and honestly with people if they're not really doing a great job. Thankfully, we don't have that many issues, and we've really hired a lot of really good talent on our team. Nail the basics of finance, the language of business. Real estate finance is very simplistic. That's why I'm in the real estate business. I'm a very simplistic person. Real estate is a great business, not just the development side, what John does, the finance side, obviously from the legal side. There's many ways you can play in the real estate space. It's just a people business, and the one thing I've learned, if people like you in this business, people are going to do business with you. When I started out, my first client, when I started in Atlanta, we had a very tough reputation coming out of the early 90s because we bought a lot of the RTC portfolios in 92, 93, the Trash for Cash program we had. So honestly, not many of the borrowers in Atlanta wanted to really talk to me. So I had to go outside of Atlanta to kind of get started. No one told me that when I took the job, by the way. So I ended up going to Arkansas, of all places, and I met a gentleman named Jim Lindsay, and a gentleman named Ken McCrae introduced me to him. That customer I did in 97, 98, 99 was roughly $1 billion in 3 years. I met that gentleman with 3,200 units of apartments. Today he has 35,000, and he never missed a beat during the cycle. And we're still friends today. We don't do as much business with him today because he's allowed with the agencies. And then back in 04 and 05, the agencies were getting strong. In 06 and 07, I basically told them, you just need to finance everything with the agencies or the life companies, because his model was the build and hold strategy. He didn't want to sell anything, and he wants to pay it down. So he basically started doing business with life companies and Freddie and Fannie on 20-year self-liquidating loans. So a lot of his portfolio now is paid down to very low levels, and it's been a huge success story. I actually told him honestly because I was doing quite a bit of business elsewhere, and he had a great model, 10-year fixed rate CMBS that wasn't the best place for him to go. And he still thanks me to this day, actually getting him transitioned over to that space, to doing fully amortizing loans, and it worked out very, very well for him. Know your strengths. Again, check your ego. Clearly, my strength's the front end. I love to sell. I love to manage. I got Andy and Dan who sit in the front row are just great partners for me. It's been a great run. If you look at the people that we have, just gentlemen in Dan and Andy's office, a gentleman named Paul Young. He's been at GE 30 years. He's a closing person, doing the same job for 30 years. He closes all our big loans. He is as much a partner to me as Dan and Andy on the front end. Our customers love him. They always request him on deals. We have another gentleman in Philadelphia who's the same way. But the one thing I want to really impress upon you, we have a bench of the domain expertise that is bar none top in the industry. People have been there for a long time. I'm there 18 in January, and there's people there 25 and 30 years. And it's been very consistent. Obviously, people retire, people move on, but the bench in our business is phenomenal. That's why the turnaround was probably as spectacular as it was, because everyone kind of knew what to do. Once we knew we were in it, we knew what to do, how to get through it. The question is, how long was it going to take? And then obviously the capital markets came back much quicker than expected, and that inflated values on all our portfolio, and the patience really paid off. Sure, we probably sold some assets cheaper than we really wanted to, but net, I think it really worked out to be a phenomenal story. And if we're going to finish this year with roughly $1.5 billion in net income. We made $900 million last year. Next year we're projected to make $1 billion because our equity sales are slowing down. Once all the equity sales are done, our business is roughly a $750 million to $1 billion debt business globally. And that actually feels right for the company. We're probably $35 to $40 billion of assets, maximum leverage at 75%. You know, I hope one day we get back into the kind of the leverage equity model where we can harvest some gains down the road, but you probably have $2 or $3 billion invested in that. We probably do some deals with John if you want to do business with us on the multifamily side. But you know, that's probably down the road on that side of it. Right now, in a world of regulation, equity is really a bad word, so it's all about debt. So we're going to keep to that story right now. But the business has come a long way. You know, and the last thing is, you know, I lead every day. I lead by example. I take responsibility. The people on my team are my friends. You know, many people ask me during 05 and 06, why wouldn't I leave the company, go to a bank for double my money? You don't know how much I make, so you don't know if it's going to double me or not. And I'll leave you with this story. A friend of mine at JP Morgan, a big investment banker, his big client is Simon Properties. I had an offer to leave. I didn't really give it much thought. And he basically made we were at lunch, and we were just kind of talking about it. He goes, so when the storm hits, when the cycle hits and it goes south, would you rather be on an aircraft carrier or a dinghy? And I chose the aircraft carrier. And I will tell you, it was a great call. I mean, it's been a great run back. If I was in the dinghy, I would have been out 3 months later, and it would have been over. But a lot of it's patience. And the one thing I'll kind of leave you with is, as you're climbing in a company, don't become impatient. Because a lot of times when people are testing you on comp and you're not happy with your pay, they're more or less testing your loyalty to the company. Because a lot of companies want to know that you're going to stay there when the markets get tough or you get big offers down the road. Obviously, they reward you later on. But a lot of companies, if it's a really big, strong company, they kind of test you to see how strong your loyalty is. And at GE, it paid off in 05, 6, and 7. And I will tell you, it really paid off in 9, 10, 11. I didn't originate one loan in 9 and 10, and my family still ate. And the company really stood by us, stood by the whole team. Granted, we were a much smaller team, but it really worked out to be a huge success. And the company's really built up a lot of loyalty. And they deserve a lot of credit to ride through that cycle. That's really it. Any questions?
Well, we have about 10 minutes for doing questions, and then we'll send all the students off to class, but
You guys got class now?
they go to class.
I thought we were going to go to the VU. Wait, so the VU's not here any longer, sorry.
All right, wake up.
And I have a question, where does GE Capital, or particularly GE Real Estate, where does it fit in the big multinational organization? You know,
All right, so
GE?
yeah,
And how do they think about you relative to selling light bulbs or nuclear generation, nuclear power plants?
GE Capital makes roughly, just round numbers, $8 billion of net income. The industrial company makes roughly $10 billion, so it's probably $18 billion net. They want GE Capital to be 30% of earnings on a going forward basis. It's going to take 2 or 3 years to get there. They want the industrial, obviously, to generate 70% of the earnings. There's some news probably going to come out in the next few weeks and some stuff, divestitures, that they're going to do within capital to shrink it further. A lot of the reason why our stock price is at 27 today, they know that we're selling pieces of GE Capital and shrinking it. They really want an industrial company. Real estate was a business we thought they might liquidate. There was a hint in 09-10 that they were going to dump the whole thing to like a Blackstone. It was all rumors, wasn't going to happen. They really told us, when they told us that they wanted us to play through, they meant it. So our business today is going to be roughly, when the whole thing settles down, we're a $750 million business. That's where I think we are. My CEO thinks we're a $1 billion business. I think we're at 750. You know, we're probably 20% of GE Capital's overall earnings at the end of the day. And we're going to have a very granular debt portfolio. The lending that we're doing today is the best quality lending we've ever done, ever in GE, back into the 70s. And it's a business that's very viable long-term. It's going to have very little risk from the standpoint of, operationally. The challenge we're going to have, to be honest with you, if the banks go to 75% leverage and do it at LIBOR plus 2. They do everything at 65% LIBOR plus 2. We're lending at LIBOR plus 3 to 400, and really not 3 to 3.25. So the challenge for us on a going forward basis is where I lose a little sleep if the banks push up their leverage. And the banks are regulated, right? So are we. but we're a finance company, and we also we have lower leverage. So hopefully the banks stay in their place, we can play in our place, the debt funds will be there. But I think long-term, we're definitely a big business for GE Capital. I'm looking forward to, I think, I've been convinced of that. The team has been convinced of that. I have 60 people on my team today. I probably have a few more analyst roles to fill over time. But that business is going to originate $5 billion plus of debt. Will generate, my business alone this year will generate $375 million in net income. That's just my U.S. business. So we're going to be half of that net income number. It's just the challenge is going to be overseas because obviously once the European banks get back at it, they're very, very competitive.
I'm curious, you're talking about downsizing period. Besides downsizing people, you're downsizing assets, as I understood.
Yes.
Who was buying?
Blackstone. Blackstone, so when we were selling assets, Blackstone's the 1,000-pound gorilla. They just closed on a lot of multifamily assets we had. We had buyers lining up for other multifamily assets, individual buyers trying to buy assets. Even office properties in certain markets we were selling into, local operators were buying them. And the deals had plenty of upside.
Where were you getting money for this? Blackstone made this smaller.
Wells Fargo, JP Morgan, Goldman Sachs, all the big U.S. banks. The foreign banks are out. Deutsche Bank even showed up to a few closings. But Wells Fargo, I'm actually a big Wells Fargo shareholder, but they are a phenomenal bank. They've done a great job through this whole down cycle. It's well documented. They're like I think $400 billion of assets. Huge bank. They lent through the entire cycle. Did a great job, backing Lone Star, buying notes. The Anglo-Irish portfolio that got sold at a discount, the Irish bank, Lone Star bought it, Wells Fargo gave them a loan. We competed with Lone Star. And they gave them a loan at LIBOR plus 250. We were offering LIBOR 375 to 400. We were 100 basis points wide. So really in 11, all the liquidity came back to the marketplace. Even in 10, it started to come back. But it was a few distinct players. A lot of the regional banks couldn't really play. That's why when they talk about too big to fail, you need these large banks. And there's no way around it. And they're not going anywhere. The regional banks are great, but if they hiccup, there's a big problem. And those guys got really caught with a lot of their residential R&D loans and even their commercial portfolios because they lend in small markets. But in 11, all the liquidity came back in the market. There was plenty of debt, and also there was a lot of equity chasing assets, so the leverage was relatively low. Guys were trying to put out 30, 40% equity in each transaction. So the equity was plentiful, and there was just, it was like, from the lending side of it, the big banks really took up the slack. Between us and 11 and 12, and JP Morgan and Wells and Goldman Sachs, there was plenty of lenders to go around. I wish they weren't there, but they were.
How much do you spend chasing a deal or researching a deal, and then how hard is it to walk away when you decide it's not right?
So we have a very thorough process. I implemented a process, and actually when I started, basically getting a deal approved by my credit guy in Dallas up front before I actually signed it up because we had such a tough reputation from the early 90s. That gentleman runs Kimco right now. If you look at our process today, we do a lot of time vetting out the deal. In fact, our prelims, Andy does a lot of them with his analysts, 10 pages, individual transaction before we actually sign it up. Right? Right? So, and it's probably roughly average 10. Sometimes they're longer, but we do a lot of detail up front on all the transactions. Since our strike zone is pretty defined, we know if we can win a transaction. So we'll win probably 30% of the deals that we really pursue. But if we're a bank, a commodity lender, you'd probably win 1 out of 10 because there's so many more banks competing for deals. In our space, there's fewer competitors, so we know typically if we have a chance to win a transaction. But since it's structured finance and you're competing in that 7 to 8 debt yield, or sometimes a little bit below, you want to get credit support all the way up the line to make sure they're going to approve a transaction. And they're not going to approve it without a lot of backup. They say they will, it doesn't happen. So we give them all the backup they need to really thoroughly analyze the deal. And as long as that math comes back, especially in acquisitions, we close 100% of the transactions. I had one mishap, actually happened 3 weeks ago. I got shot down by the GE Capital board in the deal. And we vetted it out to real estate approved it, but the GE Capital board rejected it. And I just went back, apologized, gave them all their money back. So, I mean, it's just, that's one deal out of the last 4 years. I knew I was going to get burned on one.
How do you structure your loans to mitigate against risk? And is there anything from the downturn that you modified your loans going forward?
Well, the big thing is, now we're 75% leverage versus 85 or 90.
Right.
And then we have cash on cash tests. So since we do value add lending and we're going in, say, a 7 debt yield, we basically want to see the property in year 2 be at a 7.5, in year 3 be an 8, in year 4 be 8.5. So we want to see a trajectory of income going up. If that doesn't happen, we have cash traps. So all of a sudden, we're sweeping all the cash flow from the property and using that to amortize our debt if they're not leasing. And usually we're going in at a 1.3, 1.4, 1.5 debt yield, so you get some meaningful amortization. And in the larger portfolios, you obviously have more cash flow, so that helps even more. But in some of the lower debt yielding deals, there's still, since we're financing at 3.5%, 4%, and it's a 7 debt yield, you still have plenty of cash flow to amortize your debt. So we're in a much better place today than we were back in 05 and 6, because you have positive coverage. It's 1.5 plus debt yield on many of the transactions. And you have cash traps. That's the big thing. You can sweep cash flow.
Well, I think we should give a whole nother round of applause.
Thank you, guys. Thank you.